Stocks were back on the march, reaching fresh record levels after closely watching the labor market report, which of course missed expectations. So, what does that mean? Well, additional fiscal stimulus that will go straight to stocks. Each of the three major equity indices traded higher. The S&P 500, the Dow, and the Nasdaq posted their best weekly gains since November. Both the S&P 500 and the Nasdaq ended at record closing highs, while the Dow was near its own recent all-time high. As for the details of the jobs report, well, who cares? All we need to know is that the creation of the jobs is paltry, and the number missed expectations. So now we can all stay home and continue to trade stocks. That is the new normal. We don't need manufacturing. We don't need construction. We don't need science and technology, agriculture, marketing or sales, or even finance and management. We can all stay at home and make money trading stocks with those stimmy checks. Everything is awesome. In other news, over the past 5 days, the energy sector has been the best performing sector in the S&P 500. Perhaps crude oil prices are up on the prospects for demand for travel and fuel later this year. But before you book your trip, don't forget your coronavirus passport. And the other big news is that the Russell 2000 has outperformed the other indices of late. The pundits will tell you that small cap stocks typically lead the way higher during economic recoveries and that we will grow into these valuations. Well, don't believe it. As you'll see here later, this is most likely pure speculation based on government stimulus checks. It may last a bit longer, but steer clear. Of course, in my opinion. If Congress passes something near the Biden administration's stimulus proposal of $1.9 trillion, that will bring the cumulative amount of fiscal stimulus over the past 12 months to $5 trillion. In the past year, nominal GDP totaled $21 trillion. So the injection of fiscal stimulus amounts to nearly 25% of GDP. Nothing in modern times comes close, especially during times of peace. The CBO published a report in 2010 on the military costs of significant wars. The military war costs of World War I amounted to about 13.6% of GDP, and World War II was about 35.8% of GDP. So the current stimulus spending is in the middle of the spending of the two world wars. So we all need to keep this in mind because this is a war. But it's a war against the middle class. Yes, you and me. All right, let's go take a look at the charts. Today we're going to mix it up a little bit and take a look at the iShares Russell 2000 ETF, and it's the best proxy for the Russell 2000. And the symbol is IWM, and as you can see here, the close on Friday was 221.65. So during the bottom of the recent correction, we came to that point there, which is under 100. But now we're all the way up here at 221. So we have doubled in less than a year. That is unprecedented. Now let's go on down here into the volume. Volume looks okay, nothing wrong with that. But into the MAC, you can see that the height of the MAC here, which is at 15.748, that's the highest in this 5 years. But you can go back even further, 20 years or so. This is well above anything normal. So this pace can't continue. However, if we get another stimulus check, we can continue. But time is eroding. Moving on down here, you see the same thing in the histogram. Pretty much looks to me like it's rolling over a little bit. So we go into the price rate of change, and that shows that we're at the top of this move right here. But moving on down here into the relative strength index, maybe this is a little bit of a topping process. So we need to watch this move here, because if it doesn't get above this previous mark there, then this certainly may be a topping process. Also, you can see that potential topping process in the stochastics also rolling over. We've had a pretty good run from this point all the way through here. And as you can go back, the cycle says that maybe we are about ready to head on down. Now, that doesn't mean it's going to crash, but at least we'll have a pullback. Now, into the Williams, you can see pretty much the same thing there. Nice run from that bottom up here, but I think it's getting a little old and the fundamentals may start to erode. Moving back up here to the price chart. Now, without the stimulus checks, there's no way that this indice can double in less than a year. So all I'm saying is stack your cash and be patient and prudent. And for today, that's ChewDog Charts. Thank you.